We see this shocking curve inversion now, reinvert almost through March, maximum inversion on the vanilla spread, the 2-10 spread. You look at other spreads. Why are we impatient on the signals of inversion?
Thanks for having me on, Tom. I think we're impatient simply because the yield curve is a long leading indicator with a lot of historical variation between inversion and subsequent recession. Based on the 10-year to 1-year Treasury spread, that's the one we focus on, recessions have occurred anywhere between 7 months and 25 months post-inversion, with the average outcome 12 to 14 months. So we're 11 months into inversion on that specific yield curve. And so it's just premature to say, oh, the statute of limitations is now up. We've been inverted for too long and the economy is held up. We are slowing. There's no doubt about that. But the recession debate continues to go on. But this always happens, Tom. You've been around for a couple cycles now. When the yield curve inverts, the macro data and even risk markets, do tend to hold up for some time. And so the perception is it's different this time. It's a false signal. And the it's different this time phrase is really the most dangerous in economic forecast.
As we move forward, do we disinflate?
Oh, no doubt about it. You can already see that in this slowing trend for nominal GDP. And in fact, on the income side, nominal gross domestic income is essentially flatlined. We're negative now 2 quarters in a row on GDI. And so that divergence is something to keep an eye on from a recessionary perspective. The last time we saw divergences between GDI and GDP was just before the 1990-91 and 07-09 recession started. And so we can see that deceleration in the nominal aggregates, and inflation tends to follow the business cycle. It's a lagging indicator. So wages and especially rents tend to be tied to leases and contracts. So specifically the core inflation rates, they are coming down, but they're still elevated and they will continue to come down on the back of slower nominal spending. And that's really the key variable as to whether the Fed has tightened or eased. Is nominal growth decelerating or accelerating? It's decelerating and decelerating sharply, and there's more deceleration ahead.
Well, this is critical, Michael Darda, on nominal growth, adding real GDP and some form of inflation statistic. Are you suggesting we get to sub 5% nominal GDP? I think a lot of people out there aren't expecting that.
We're already there, Tom, on the gross domestic income figures, and those tend to be a better barometer of where GDP will be revised to in the future. So we're limping along at barely 1% annualized nominal for GDI. Now, nominal GDP is still up in the mid fives, or if you take the 2 average a bit higher. So, a 4% trend would be consistent with about a 2% inflation rate. And I think we're going to get there, if not fall below that, in the near future.